Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and we're getting an update today from Doc Jones, a private activist investor in the resource space, and you can see him over at CEO.ca and also comments a lot on X/Twitter. And we'll put links to both his pages down below this interview so you can follow along with his thoughts on the markets. And Doc Jones, great to get you on the show as always, just to dig into what you're looking at. And we were having a nice conversation off mic before we started recording just about some of the changing winds that we're seeing in the energy transition narrative and what we're seeing around electric vehicles and some of the forecast and actually what's happening with manufacturing companies and how this all ties into kind of a stew of different factors, but it's still very positive for the commodity sector. I'd love you just to break down some of the comments we were just talking about how you see the energy transition and in particular what's going on with electric vehicles. The narrative is slightly changing.
Hey, Shad. Yeah, that's definitely an understatement. Yeah, so what I'm looking at in the energy transition, specifically in the auto market, I'm going to list off a few little quotes here. Ford suspends new EV models after losing $1.3 billion for EV division. Mercedes walking back all EV future to invest in high-tech internal combustion engines. Volvo will be coming back with hybrid petrol engines as demand for EVs stalls. McKinsey, 46% of U.S. EV owners want to switch to internal combustion engine vehicles. There's the narrative being pushed out by the politicians, we'll call it virtue signaling and all that. And then there is the reality. The reality is that pure EVs, they just don't work. They don't work as well as we wanted them to, and the technology isn't there. And people are gravitating now and looking to go to the hybrids and back to internal combustion engines. The newer hybrids are great. They've got dual independent powertrains, and extended life batteries, so that they have the batteries now that can go about 60 miles on a charge, and then a internal combustion engine, and together they work really well together. So what does that mean as an investor for the commodities market? Last year, people thought that PGMs would be dead forever, that platinum, palladium would never get a bid again and would go into obscurity, so to speak, because you need those for catalytic converters. So it looks like that going forward, we're going to see a deeper penetration of sales growth coming out of hybrids. So that's going to be really bullish for PGMs. And that's great because people have left them for dead. So there's a lot of value to be gleaned from that sector. You know, I look at Magna Mining, for example, where they're going to start blasting rock in July, and they're going to be tolling the 109, which is a copper PGM rich zone in the Crane Hill deposit at a time when PGMs are on the uptick. So yeah, that's great. Also, that relates to oil demand, right? So these forecasts that oil demand would be rolling over sometime in the next few years and go into terminal decline has been proven to be extremely false. This year, the demand figures look like we're going to come in at an average of 103 million barrels a day, peaking out in August close to 105 million barrels a day of demand. And then in 2025, peaking at 106 million barrels a day with an average of 104.1 million barrels a day of average demand through 2025. The world has never produced that much oil. And every year, the incremental demand, though the demand growth is petering off, it is still growing by an average of 1.5 million barrels a day of demand incrementally, which if you look at the oil and gas sector, there's been no investment in the last decade or two in new production, meaningful, that is going to replace just the terminal decline rates that are out there. Like in the world, we lose about 6-7% of oil production a year just from depletion, which equates to that we have to bring on production about 6-7 million barrels a day to stay even. So to compensate for growing demand, we have to bring on, if it's growing 1 million, 1.5 million a year, we need to bring on 7, close to 8 million barrels a day just to balance the market, which I don't see happening. So I've been looking at increasing my exposure to oil-weighted producers, in particularly in Canada, where the balance sheets are very solid. They're paying dividends and buybacks. Like Surge Energy is one of my favorites there because it's 90% oil-weighted, light oil and medium oil, and they've been executing on their capital plan. Recently, they had a press release that most people, I don't think, really took a lot of time to take a look at or acknowledge, but they issued a buyback. They increased their base dividend, and they also made a discovery in the Sparky. So yeah, they're on track to be net debt free in the next year and a half, while increasing their dividend to where it pays about an 8% yield plus a buyback. And then you get that compounding rate where the float is decreasing, earnings are increasing per share, cash flow per share. And you're only paying you're paying a discount to the proved producing and getting the P2, P3 reserves for free. So that's really, really exciting. So that's how I'm looking at the energy transition as far as when it comes to automotive. And then with the reshoring narrative and the data centers, which we talked about, and manufacturing coming back to North America, particularly the United States, we need a lot more power generation. So that would either be, or a combination of probably nuclear and natural gas. Myself, I stick with my core competency. I wouldn't say that I'm as a student investor in nuclear, so I focus on the natural gas side of that equation. And much the same with the oil side, there hasn't been a lot of investment. And there's quite a bit of export capacity coming online, both in Canada and the United States, which will start taking some of this stranded gas to the world market, as well at a time where we're seeing more and more demand from the industrial sector. That you should see, and you can see it in the forwards, like the Alberta gas a year from now. Right now, Alberta gas I think is about 80 cents. A year from now, it's about $3, and that has to deal with all the export capacity coming online. So going forward, you should see a nice bid under natural gas where maybe we put in a floor around $3, and depending on demand, we spike up to $6 or $7, and you can make a lot of money producing gas at $3-4 an MCF.
Oh, absolutely. And it's been interesting to watch nat gas kind of bottom over the last, let's say, 6 months, down around 150, pop up to 3. But to your point, with all these LNG terminals coming on in Canada and the United States and more exporting, it probably will mean that domestically prices of natural gas will creep a little bit higher, whereas internationally maybe they come down just a little bit with more export capacity out of Canada and the U.S. But the reality is we're going to need a lot more nat gas for nat gas power plants. And we're going to need a lot more nat gas just to power the world. But with this energy transition narrative slightly changing, we were also talking off mic that it changes a little bit which batteries are in focus on the hybrid, dual powertrain cars, maybe to more nickel focus. So that's an interesting area. And then, of course, no matter which way you look, all of this electricity narrative, whether it's AI data centers or crypto mining or EVs plugging into the grid, we're going to need a lot more copper. So that kind of brings into the equation the focus on copper that so many investors have. I know that for a while we've discussed Emerita Resources as a way to get copper exposure. You also brought up Magna Mining there, but anything you'd want to say about Emerita, because they've had some interesting news out recently on some recent discoveries.
Yeah. Emerita as a whole, like as of today, we're less than 8 months from the historic court case for the Asna land package, which has 26 billion in situ high grade resources on it. But on their 100% owned property, the IBW, there's a third deposit there that they just started delineating because they didn't have drill core data on that. Originally, when they won that package from Trafigura Metsa, Supreme Court reversed the tender and gave it to Emerita. They had drill core data on La Infanta and Romanera, and they've drilled out those two deposits, delineating about 20 million tons thus far. And then they started drilling El Cura, which is in the center. And it turns out that they're proving up what is in some of the historical documents, that it's a high grade copper gold VMS system. So as of now, they released a hole about 2 days ago, just the visuals. It was a step out from the previous hole, which you could call a discovery hole, where they hit zones of high grade copper and gold. And it appears that the lens itself is expanding at depth. At 50 meters above, it was about 8 meters. Now it's about 12 meters wide, and there's a lot of chalcopyrite veining and base metals indications. So that is looking very, very strong. And just on the drilling they've done, if you do a block model on just what they delineated and do like 50-meter blocks around these drill holes for a potential inferred resource, you're looking at probably around 3 million tons thus far. Should that continue to expand, this will become a very meaningful deposit to the whole project because they're all within trucking distance of each other, these three deposits for a mill that has been planned for right next to La Infanta. And because it's close to surface, there's so many economic advantages there. But that's looking really interesting, as well as, with Magna, with its high grade coppers that it's pulling out of the footwall at Crane Hill. Yeah, there's a lot of interesting upside. Right now, we were talking before, and the market, there's so much dislocation in the market right now and such a lack of liquidity and capital that you really don't have to go very far down the risk curve as far as going into pure exploration where you live or die by a drill hole. You can go into these developer explorers that have the downside hedge of a delineated, compliant resource that you can put economics around that also have upside to exploration, much like Magna Mining or Emerita or Abitibi Metals, which I've talked about in the past, and all these companies too. The thing that I like about them and why I have been consolidating my portfolio, partly because of the change in tax laws. In other areas, I took losses to capture the tax benefit of that early this year, to focus in on my best ideas that have the attributes of a resource that's already been delineated, that is on back of envelope, very economic and has the scale, and as well as these companies have cash in the bank and won't be tapping the market anytime soon. Like Magna's got 15 million in the bank. Omai Gold just raised 13 million upsized without a warrant. Abitibi Metals has 17 million in the bank. They said they don't need to raise capital again until 2026 to execute on their plans there. And Emerita just raised 5 million recently, and they have, I think, about 9-10 million in the bank, including the tax refund. So yeah, it's a great time to be a resource investor if you have capital to deploy. Because also the deals that I'm seeing that are coming across my desk, now you're getting into the 3-year full warrants, 4-year full warrants. Pretty much everything is attaching a warrant to it. Very few, like, oh my, I was very surprised that they got that deal done without a warrant. I wasn't surprised because I don't think the project is great or anything like that. It just seems it was going against the norm in the market at that time. So that's really where I'm at here. With the political backdrop, it looks like, without choosing sides, statistically, it looks like we're going to get a Republican president and a conservative government in Canada. What that means is that there will probably be a walkback of all these green initiatives. Poilievre has said that he wants to axe the carbon tax, and he's very supportive of the resource sector. So does that mean tax cuts in the future for business? Does that mean a lot of spending and government programs to promote the development of natural resources? I don't know, but investing is about probabilities, and it seems more probable with those administrations than the current ones that we have now. And like with Emerita, they're being awarded a distinction of strategic importance for the IBW project by the government, which it doesn't guarantee that they will get funding from the Euro Fund that was set up. There's the $3.2 billion Euro Fund set up to promote mining and smelting in the Iberian Pyrite Belt. But with that distinction from the government and essentially having the government as a partner, I would think that the probability of that being possible has increased considerably. And what does getting some kind of grant in the tens or hundreds of millions of dollars do to a project's IRR? It certainly supercharges them for any company that's in that position. We saw that with the DOD, with some of the companies in the United States. Talon, I think it was, that received a large grant from the U.S. government for their nickel project, which certainly increased their market cap and value if you're adding equity at zero cost to shareholders in the form of a grant. Magna's in the same position, awaiting to see if they were going to receive a grant from the DOD, and I think they posited something like they were looking for 50 to 70 million from the U.S. government to build Shakespeare. If that comes to pass, in the previous PEA on Shakespeare was about 240 million to build that mill. So if you get almost a third or a quarter of your capital given to you for free, that certainly changes the economics in a vastly positive way from something that was already quite attractive to something that is quite amazing. Like the example would be, Shad, if there's a house that's $1 million, all the houses in that neighborhood are selling for $1 million, and I say, I will sell you my house for $750,000. You take that deal every day of the week because right away you've just made a return on your investment from day one.
Absolutely. I think that it's important to look at how the governments in Canada and the U.S. and that's happening in Europe as well, as you highlighted with Spain, with Emerita's case. But seeing the governments get involved in the mining space is something that none of us are really that used to, because usually they're trying to limit it. So you brought up two good points there, not just the funding from government, but possibly the easing of restrictions on the permitting side of things could be a boon for a lot of these resource companies. I want to circle back to something you just said, though, because I do want to squeeze in precious metals here. You mentioned Omai Gold Mines, that they just got that funding. I think that's the other key point, is that there's the haves and the have-nots. If you have cash right now, you can do meaningful work programs. If you don't have cash, you're kind of sitting dead in the water. So let's talk about Omai and what they're going to use that cash for.
Yeah, so Omai is really interesting because Elaine there came on board about 2 years ago, and since owning the project, they've had the project for just under 3 years. They've done, I think it is 3 or 4 resource updates going from 0 to 4.3 million ounces, but they've never really had a lot of money. They've only had a few $1 million at a time. Like the financing prior to this one I was involved with, and that was at 7 cents and a half warrant at 11 cents. And they raised just a few $1 million just to keep moving and advancing the project. But now with the jurisdiction being validated by G Mining buying out Revival Gold, and there was the other one in the same area that was bought out by a smaller producer, there's quite a bit of demand for this jurisdiction. So they were able to raise, initially went for 10 million, they raised 13 million without a warrant. And now they're going to take that money, and they had put out a starter PEA that was just on a portion of the open pit before, just to give people an idea of the plausible economics going forward. So they're going to take that money, they're going to drill the gaps between, there's some sparsely drilled areas on the edge of the current pit shell. And outside of that, there's about 500,000 ounces that weren't included in the last PEA at about 2 grams per ton. So you're going to connect that up. And then they're going to use the money to keep expanding. Like this pit currently, I think it's about 2.6, 2.7 million ounces in there. And it looks like that could easily be pushed to over 3.5 million with the data that they have to connect the drill hole so that they can get it into an inferred and then to an indicated. And then they're going to redo a PEA that includes the underground deposit, that they have this beautiful underground deposit that it's like just a big blob where they have intercepts that are like 100 meters of, 3-4 grams per ton. It's very homogeneous. So it's 1.7 or 1.8 million ounces, begins just below the historic pit that is there on the property, 350 meters down. So they'll do a PEA to connect all that together. So you'll see a PEA now where it'll show production probably of like 250,000 ounces a year, mine life of 25 years, with including all the resources and whatever resources they add between now and then, where you're starting at 4.3 million ounces at very good grade. Maybe it's 5, maybe it's 5.5 million in the next economic study. But now they have the money to really, really just go, because they're funded for the next probably 2 years, I would say, which is fantastic. And the evaluation they have currently is still, compared to peers, they would have to appreciate 3, 4, 5x to come into a peer multiple based on the 2 acquisitions that happened of their neighbors. One which was about a little less than half the size of Omai as far as resource, and one that was about 20% larger. But yeah, that's a fantastic company. It's a brownfield site. They have the president of the country with his arm around the CEO saying, and this was in the newspaper, we want this mine. When will you be back into production? So it ticks a lot of boxes as far as, what risks have been diminished. Well, you have the social license, you have government support, you have cash in the bank, you have historic metallurgy that showed excellent recoveries. It's a brownfield site, so there's a lot of infrastructure there. One of the old open pits they're looking at for tailing storage. So, there's a lot of capital that gets saved by utilizing some of the past infrastructure that is still available on the land package. Yeah, so that's basically Omai in a nutshell. Of course, I'm biased because I'm a shareholder. I'm a shareholder of, I think, of every company that I've talked about here today. So, yeah, you have to do your own analysis. But yeah, there's a lot of low-hanging fruit there that will be brought into the next economic study, which should be within the next 8 months, I believe.
All right, I appreciate you giving us an update there. And we've had Elaine on the show before, so I'll reach out to her and try to get an update now that they are cashed up again. And so that's the theme that I picked up from this interview, Doc Jones, is that it's good to be cashed up. It's good to be in a commodity that's in high demand, and all these commodities are in high demand. And we'll keep following along with all those stories. And if people want to follow along with Doc Jones, again, definitely click on the link below this interview. It takes you over to his page at ceo.ca and over at X, where you can follow along with the companies he's looking at, the research that he does, and the deep dives into these companies. And as always, looking forward to our next conversation.
Yeah, thank you, Shad.